Coinbase is up over 20% from its February lows. If you've been watching this channel, you know I flagged coin as bearish at 164 3 weeks ago. So does this 20% move change anything? I pulled up the IVT terminal this morning, and what I'm about to show you is one of the most important lessons in institutional volume analysis, because the chart is telling you a completely different story than the price tag. Stay with me. Welcome to the Cantillon Research. I am Jesper. This channel is built around one framework, the Institutional Volume Terminal, or IVT as I call it. A system designed to read what institutional money is actually doing, not what price alone suggests. The core philosophy here is 3 words. It's regime first, volume second, and price last. What that means in practice is this: price is always the last thing to tell the truth. Volume structure and regime confirmation tell you first. Coin is a perfect case study in why that order matters. So let's get into it. Let me give you the full picture first. Coin peaked at 445 last year. It's now at 197. That's a 56% decline from the top, even after the bounce we've seen over the past few weeks. Now, 3 weeks ago on February 13th, I published an elite research report on coin through the Cantillon Report. The IVT terminal at that point was reading bearish at 164, with a confluence score of 5 out of 10. Moderate institutional interest, but no structural reversal signals. Since then, price has moved up roughly 20%. And if you are a trader, you are asking one question: has the regime changed? The short answer is no. But the longer answer is more important than the short one, because understanding why the regime hasn't changed, despite a 20% move, is what separates institutional level analysis from chart watching. So let me show you exactly what the terminal is reading right now. This is the IVT terminal on the 4-hour time frame. The bias you see here up in the right corner is bearish. It's unchanged. That's the first thing you see. Despite the 20% price rally, the regime hasn't flipped. VWAP deviation is minus 29.6%. This is the one that stops me cold. 3 weeks ago, when I published the report at 164, VWAP deviation was 2.9. Today, at 197, a higher price, the VWAP deviation is 29.64. Let me explain why that's significant. VWAP deviation measures how far current price is from the volume-weighted average price, the institutional cost basis anchor. A wider negative deviation at a higher price means one thing: the institutional reference point, the AVAP, has been resetting higher as the bear structure matures. In plain language, institutions who are anchored to the volume profile of this move are sitting on a cost basis that's now nearly 30% above where price is trading. The gap has gotten larger, not smaller, during this rally. That tells you the rally has not been driven by institutional absorption. It's been driven by something else, and we'll get to what that something else is in a moment. The confluence score is 1 out of 10. This is the lowest reading the terminal can give. 3 weeks ago it was 5, today it's 1. More on this in a moment, but a confluence score of 1 means the terminal has identified almost no structural evidence for a regime reversal. The indicators that need to align for a bullish regime to confirm are not aligned. The swing age is 370 bars. On the 4-hour time frame, 317 bars represents a significant mature bear swing. This is not a fresh trend. This is an entrenched, deep structural move. The longer swing matures without reversals, the more institutional confirmation it carries. And then we have the swing type. It's bear. Stability 0 out of 2, 0 stability. This is critical. Stability measures whether the volume profile is consolidating into a base. Zero means no evidence of institutional accumulation at current price levels. None. The volume profile is not building a foundation here. And when we look at the volume compression, it's expanded by 54%. 3 weeks ago, volume compression read expanded 0. Today, it's expanded 54%. Volume is expanding in the wrong direction. For a sustainable reversal to occur, you want volume compressing, the market coiling before the directional move. What we have instead is expanding volatility in a bear regime. That is not a setup for a sustainable rally. So before I even get to the most important reading, the Cantillon Flow, here's what the terminal is telling us. Price went up 20% and every structural metric got worse. VWAP deviation widened, confluence collapsed, volume expanded further, zero stability, mature bear swing. The price move and the volume structure are moving in opposite directions. And let's look at the Cantillon Flow section. It says speculative. The macro bonus is -1. The composite score is -3 out of 9. Now, here's where it gets really interesting. And this is the core of what the Cantillon framework adds that pure chart analysis misses. Cantillon Flow is reading speculative. The 3-layer breakdown, liquidity is red, equities red, risk assets green. In the Cantillon framework, institutional money flows sequentially. Liquidity improves first, bonds, gold, money markets. Then that improvement flows downstream into equities. And only after equities stabilize does money flow into risk assets. Crypto, high beta names, leverage plays. When you see that liquidity and equities are in red and the only thing that's positive is speculative instruments, that's the speculative configuration. Risk assets are being bid, but liquidity and equities are both bearish. And what does that tell you? It tells you that what's driving coin's 20% rally is not a broad-based institutional rotation. It's speculative positioning in risk assets while the upstream layers, the ones that need to be healthy for a sustainable move, are still deteriorating. This is the configuration you see in bear market rallies. It's the configuration you see when retail and short-term momentum traders pile into a high beta name on good news. In this case, the February CPI print, but without institutional backing. Compare this to 3 weeks ago when Cantillon Flow read accumulation. That was when the bonds were bullish, but the equities and speculative assets were bearish. That was actually a more constructive setup despite the lower price, because at least the upstream layer, liquidity, was building. Now even that has deteriorated. The macro bonus has flipped to -1. 3 weeks ago it was +2. The macro environment is now a headwind, not a tailwind. And the composite score is -3 out of 9. That is a deeply negative reading. So let me give you the complete picture in one sentence. Coin rallied 20% and the IVT terminal moved from moderately bearish to structurally weak. The upstream Cantillon layers are worse today than they were at 164. The 20% move was a speculative rally, not a regime change. I want to pause here because I think there's a lesson in this chart that applies beyond coin. You'll notice these strong diversion labels on the chart. Divergence signals. In most technical analysis frameworks, divergence signals in a downtrend are treated as a potential reversal warnings. Bullish divergence between price and an indicator. But here's the problem. In a mature bear structure, 370 bars, zero stability, expanded volume, zero confluence, divergence signals are not reversal signals. They are relief valve signals. The market is releasing pressure, not changing direction. This is the core between reading price and reading volume structure. Price showed you a 20% rally. Volume structure showed you expansion, not compression. Price showed you divergences. Volume structure showed you zero accumulation. The IVT terminal doesn't care about divergences in isolation. It asks, is the volume profile building a base? Is institutional cost basis being absorbed? Is the regime confirming a change in direction? And for Coin today, the answer to all three questions is no. This is what I mean by regime first, volume second, price last. The price gave you a green candle, the volume structure gave you the truth. Now here's where the institutional framework gets specific. In the Elite Research Report I published 3 weeks ago, I identified the exact AVAP levels that need to be reclaimed for the regime to flip. I identified the volume compression threshold that signals a coiling setup, the preconditions for a sustainable directional move, and I outlined the 4 specific conditions the terminal needs to confirm before coin becomes actionable from a long side. That framework is still valid. And in the updated analysis I'm running for paid subscribers on the Cantillon Report, I mapped exactly where those levels sit relative to today's price, and what a genuine regime reversal would look like if this speculative configuration eventually resolves into something healthier. The specific levels, the IVT targets, and the position management framework for coin are in the paid report. I'll link the Cantillon report below. Free subscribers get the macro context and regime reads. Paid subscribers get the full instrument level analysis, the AVAP levels, and the IVT targets. Free subscribers get the full instrument level analysis, the AVAP levels, and the IVT targets. The free tier is genuinely useful, but if you want to know exactly where the terminal confirms a regime change on coin, that's what the paid tier is built for. So let me leave you with this. A 20% price move feels significant. And if you're trading coin right now based on price action alone, I understand the temptation. The CPI print was good. The macro narrative is shifting. The Coinbase business is genuinely building something important for the long term. But the terminal is unambiguous. Volume structure is weak. Cantillon Flow is speculative, not structural. And the AVAP deviation is wider today than it was at lower prices. The regime hasn't flipped. The regime hasn't changed. And in this framework, we don't participate until it does. If this kind of analysis is useful to you, and if you want to understand what institutional money is actually doing before price confirms it, subscribe to my channel. I publish these regime reads regularly, and the framework applies across equities, cryptos, and macro. And if you want the specific levels and the IVT targets, the full playbook, the link is in the description. Regime first, volume second, price last, and I'll see you in the next one. Trade safe. Bye.